Hello, everyone. My name is Sarah Rapucci. I'm a Senior Director in Fitch's Credit Research Team. Welcome to Fitch's webinar on software exposure in private credit and leveraged loans. Before we get started, I want to go over a few quick housekeeping items. For the best experience, we recommend that you use Google Chrome, and if you experience any technical issues, please try refreshing your browser, or you could pop a question into the Q&A box. A copy of today's slides and related research can be downloaded from the resource list. And we hope to answer questions at the end of this webinar. So you can please submit them through the Q&A box. We'll keep track of them. And if we don't get to your question, we'll try and follow up with an email afterward. With that, let's get started. Rapid AI advancements have raised market concerns about products and services vulnerable to AI disruption. And I'm delighted to be joined today by a group of experts from across Fitch's ratings coverage to discuss software sector exposure and loan performance across leveraged loans, private credit markets, and CLOs. From our corporates team, we have Alan Lin, who is a senior director covering the US technology sector, and Lyle Margolis, who heads our private credit coverage. Deborah Ogawa is a senior director and global coordinator for Fitch's CLO research. And from our non-bank financial institutions group, we have Chelsea Richardson, a senior director covering business development companies and other finance companies, and Davina Dunmore, a senior director who primarily covers alternative investment managers and securities firms. Alan, let's get started with you. Sorry, let me advance the slide here. Alan, you've co-authored a couple reports recently on the AI ecosystem. One of them, which was titled Beyond the Hyperscalers. I highly recommend people check those reports out. In this Beyond the Hyperscalers report, you assessed AI disruption risk and overinvestment risk for 14 corporate sectors. And you found that software, media, and services, and let me try that again. You found that software, media, and services, which are all asset-light sectors, are the most vulnerable to AI disruption. I'm wondering if you could tell us a little bit more about how you see these risks playing out in the software sector.
Sure. Thanks, Sarah. Yeah. So, just thinking through, what AI really means for everything we do, right? AI ultimately reduces the time and efforts required to perform certain specific functions. I think we can all familiar with using LLM to summarize and generating text. That's very relatively easy to do. For software developers, right, they've been able to use LLM to generate software codes, and that's being widely adopted across the software industry already. And more specific industries of functions, right? Call center, customer call centers, right? Those I think we've experienced, right? A big part of that can be done through AI as well. So what do all these mean, right? Obviously, some of these functions do overlap with existing software products, right? And that obviously raises concerns for software companies, right? If AI can actually replicate these functions, what's the risk to the existing software products? So, looking at this type of, efficiency gain, coming from AI, right? There are two things, right, that come to mind, right? The one is, right, can companies, the customers, can they insource the software tools instead of buying from third-party suppliers, right? Can we build these tools in-house? Second is, right, if it's easier to develop software codes, right, does it increase competitive intensity because it's easier for new entrants to come in? So kind of answering the first question, right, insourcing of software tools, right, we find that to be low probability. And it's for the same reason that enterprises over the last 2 decades have generally outsourced software tools to third-party vendors rather than trying to develop these tools in-house. The implementing AI, right, it still requires significant effort to actually get it to work in a particular environment, and the efforts put into tool development, right? I think for a large enterprise, it's really viewed as a distraction for large corporations, right? Because their core business is doing something else rather than trying to develop these tools. Now, for the SMB customers, right, who could save money by using AI tools to replace third-party tools, they simply don't have the IT resources to actually do these things. So we find the insourcing of software development to be a relatively low probability. Now, on the other hand, right, kind of looking at the potential increase of competitive intensity, right, we find this to be possible, right? If a new entrant can use AI tools to rapidly develop software codes and build products, right? We could see more competition in the marketplace. The net results we have yet to see, but we could see are that there could be pricing pressure, right? And there could be higher sales and marketing expenses, and revenue growth could be a bit weaker, right? So ultimately, right, we could see profit growth to slow down, right? Again, we haven't seen evidence of this happening yet, but if there's a greater competitive intensity, we believe these are some of the metrics where this intensity could show up at. Now, having talked about what's possible, right? I do kind of want to go back to what are the software attributes that make software products resilient and robust, right? The switching cost is still very relevant, right? If you have a product that is a standalone point solution, those are clearly vulnerable before AI and with AI, right? Because if you're a standalone product that can be replicated easily and replaced easily in a workflow, those have always been vulnerable, and I think they will continue to be vulnerable. Now, we do have a lot of the software products that are deeply integrated into a customer's work environment workflow. High switching costs, right? That is still very relevant. Trying to replace a deeply integrated software product is still complex. So the switching cost to an AI solution will also be complex as well. So I think those attributes we do want to keep in mind, right? They still exist before AI, and with AI, that's still the case. So kind of tying this back to the slide, right? Why do we rank software as being a higher disruption risk, right? At the end of the day, right? Software is highly exposed to AI, right? Because AI really inherently is software, and some of these functionalities can be replicated as just discussed. But there's also mitigation, right? We expect the software industry and software companies to be very adaptable. In fact, if you look at the AI adoption over the last 2 years, arguably software is probably one of the most advanced in terms of AI adoption. And the software attributes where we always talk about the stickiness of software products, those attributes are still unchanged with AI, right? The switching cost is still a crucial factor. But we do have to recognize that there's potentially more competition just because the barrier to entry to build a new software product becomes easier.
All right, so I'm hearing that there's some varying levels of vulnerability and I'm wondering if you could help us pinpoint where we see some of those vulnerabilities and strengths in the software sector.
Yeah, so we've gone through over 100 software companies internally just to assess the relative risk for their business model, for their specific products. And we roughly kind of break them down into like 10 different categories of software. Now, the ones that we find to be more vulnerable, right, they tend to be in the productivity, workflow management functions, data analytics, right? We can see AI performing some of these functions, and IT operations. So we do find higher risk within these buckets. Now, the ones we view as being stronger, more resilient, If you have a software that is really the infrastructure and the kind of the system of data, a database product, ERP product, right? Those are still resilient. They're highly integrated. They run infrastructure. In fact, to make AI work, right, you need these layers of software to work properly. Healthcare IT, we do see that as being quite resilient as well, because in a highly regulated environment, and the outcome of these products, they need to be deterministic, right? Using AI tools, it's more probabilistic. You may not get the same results every time, right? So I think these highly regulated healthcare IT products should be quite resilient. And IT security, right? That space is always evolving over the last couple of decades and continues to be. They will need to evolve with all the new AI threats, right? But that is a sector that will evolve and should still be very relevant. Now, talking about how these companies continue to evolve, right? What we expect to see is today, right? We are mostly working with the large language models, and again, software companies are early adopters in adding AI capabilities into workflow and different product offerings, right? I think every software we talk to, they are adding some sort of AI functionalities into their products. Now, what we should expect to happen in the next couple of years, right? There's more and more talks about agentic AI. AI agents will depend on tools, and we view AI agents as being complementary to the software tools that exist, because these agents will need to call on the different functions, whether they're AI tools or software tools, for these AI agents to work, right? So that's our expectation. Now, coming back to how do we view our entire software portfolio of over 100 software companies, right? The way we score them, I think the outcome is that roughly 50% of the 100 companies we view as being in low risk category. And there's roughly about close to 10% we view as being high risk. Now, there's that 40% in between, right? That's 40%. We do see AI exposure. However, we do expect them to be able to adapt with the AI capabilities, and most likely they will be able to compete effectively in the age of AI.
That's very useful. I appreciate that. Let's move on. I'm going to turn to Deb. Sorry, let me get the right slide up. So, Deborah, it's my understanding that software tech obviously is a top sector for leveraged loan issuance, but I'm sure it must be in a material industry category for CLOs as well.
Yeah, that's right, Sarah. And let's just start with the leveraged loan side of it. Software leverage buyout and M&A volume surged in 2019 as well as 2021 to 2022, and many issuers had high valuations, which created significant risk for this segment even before we started talking about AI disruption. So, as you can see from the chart, 2024 and 2025 were the first years in which we saw software defaults represent a meaningful portion of institutional leveraged loan default volume. Software defaults made up 12% of 2024 default volume and 14% of 2025 volume, and that was up sharply from the 2% that we had seen over the previous decade. Now, thinking of what we're watching now, our leverage finance colleagues maintain market concern lists, and the top market concern list are companies that Fitch expects to default in the next 12 to 24 months. And tier 2 list issuers are those that are likely to default, but the timing is a little less certain, as they may have levers that they can use to avoid defaults. Now, approximately 15% of software companies in the institutional leveraged loan universe are currently monitored on one of these two lists, and it's basically split evenly between the two.
So what does this mean for CLOs, Deb?
So technology software is one of Fitch's 29 industry categories, and in line with the issuance trends, it tops the industry exposure in Fitch-rated broadly syndicated loan CLOs with about 13% exposure on average. And this hasn't really changed much over the year, as you can see from the bottom chart. Now, what we're seeing right now is that less than 1% of technology software exposure is currently on our watch list, and that combines the top market concern loans list with those otherwise rated CCC plus and below. Now, understanding that concerns are rising on AI disruption and the possibility to see rating migration from it, we ran a sensitivity to see if a relatively severe rating migration within the industry category could result in unexpected levels of CLO note downgrades. And the answer to that was no. So we took all tech software obligors that were rated CCC plus and below to default, and we downgraded those issuers at single B and single B minus by 2 notches. And this means that the typical CCC plus and below exposure in CLOs went from 6% to 15%. And you can see the migration on the slide in front of you. Now, we consider this to be a more severe scenario than what we would expect to experience, and especially as we considered it to happen all at once instead of over time. And the severity of this was to compensate for possible issues to companies in other industry categories, such as business services. But despite this, we found that break-even default rate cushions, or our so-called cushions to downgrades, remained robust. Investment grade rated notes were resilient, though there was a tail of double B notes that we saw that could be vulnerable to downward portfolio migration, and that could come from any sector. So turning to middle market CLOs, we see that technology software is also the largest industry concentration in Fitch rated middle market CLOs as well. And the sector here represents about 17% of middle market CLO portfolios. And we're currently working on a similar rating migration analysis for middle market CLOs where we look forward to sharing that with you soon. Our early results from the sensitivity look to be in line with what we saw for BSL CLOs, in that there were minimal CLOs that their BDR cushions completely eroded. We, though, acknowledge we could see more variability in middle market CLOs, and that's because there's less diversity and smaller obligors are going to be more vulnerable. And against this backdrop, we're already seeing deferrable exposure increase in middle market CLOs. It rose from around 7% early last year to about 9.5% in February 2026. This is what the blue line shows. And deferrable exposure is linked to obligors that are allowed to pick some of their interest, but they are also paying a portion in cash. Technology software deferrable exposure is one of the top industry categories, and this rose from 1% at the start of last year to almost 3.5% in February, while the other sectors remain broadly stable. The red line here shows deferring and defaulted obligations, and deferring is when the obligor isn't paying any cash interest. Defaults include obligors rated CC and below. In either case, we don't give credit in our CLO analysis to PIK interest at all. So just summing it up, although deferrable exposure has been rising, it hasn't translated into higher defaults at this time, but it is something we're watching. As you can see, defaulted and deferring exposure has stayed low in middle market CLOs and is currently trending around 1%. But I look to my other panelists to provide more color on this segment of the market.
Thanks, Deb. And I would just reiterate that the BSL CLO study stress scenario that you were speaking to is found in a report that we published. So that's on, it should be in the resources page if you want more detail. Let's move on to Lyle. Lyle, I want to come back to the software private credit profiles and performance, and I'm wondering what you're seeing.
Yeah, hi, Sarah. Thanks, everybody, for joining. So let me first preface by saying we've got two portfolios of private credit that we can tap into. One is credit opinions, which were kind of light versions of ratings that we do for Deb's team for the middle market CLOs. We got a portfolio of over 1,000 issuers that we provide opinions on there. But we also have a portfolio of what we call privately monitored ratings, or PMRs, and that's what the data that you'll be seeing going forward here pulls from. And those PMRs are ratings that we do, and I'm using the word ratings there as opposed to credit opinions, which I used before. Ratings that we do for asset managers on behalf of their insurance company clients, and those insurance company clients need those ratings for regulatory capital purposes. And I like to focus on the ratings side of the portfolio because we really get some deep insight into these issuers. We see these loans really from inception to retirement, whatever retirement might be. And retirement might be, the loan gets paid down through a refinancing, or through a sale of the company, or the loan defaults and converts to equity, or the lenders take control of the company. So you can see from the slide here that the trends in the PMR portfolio in the software sector have actually been somewhat positive. You could see in the top right quadrant there the chart on coverage. Obviously, coverage came down quite a bit post-COVID as interest rates were on the rise. Obviously, rates have started to come down a little bit, and that's helped boost coverage metrics within the portfolio. But we've also seen some spread compression as well, as the market, until this year had kind of been tightening along with the BSL market. So you've seen some both the benefits of rates coming down and a spread compression. And this is a sector that's really highly vulnerable to rates, right? You've got very levered cap structures. These cap structures, probably average leverage in the 5 to 6 times. They don't do a lot of hedging, and very often the entire cap structure is floating rate, so can be very vulnerable. But you can see on the left also leverage has been coming down, and part of this is going to be from more conservative underwriting, as we've seen new loans coming into the portfolio that were maybe a bit more conservatively underwritten. But it's also partly a maturing of the portfolio. I think it was Deb mentioned that we saw a lot of issuance, kind of pre and post COVID. A lot of these loans are for issuers whose business models are maturing, and you can kind of see some of the evidence of that in the lower charts, right? You've got revenue growth, very high in the early 2020s, and coming down a bit, still pretty healthy, right? Still around double digit revenue growth, but coming down, kind of reflecting a maturing of some of these issuers. But then on the bottom right, you can see that EBITDA margins have been improving quite a bit. Again, probably a function of both the maturing of loans in the portfolio, but also higher quality loans coming in as well. Okay, so maybe we'll just jump to default rates and what we've seen. So the BSL default rate ended last year at 4.5%. The PMR default rate, on the other hand, was a much higher number, 9.2%. And we view, in our opinion, that the PMR default rate is going to be kind of structurally higher than the BSL default rate. We use the same criteria that for private credit defaults as we do for public defaults. But what we see in the private credit portfolio is a lot more what we call collaborative defaults. So that's sponsors and lenders working together to help support a company. And that very often takes the form of issuers, private credit, lenders rather. When a company encounters some stress, the lender is offering to, say, PIK interest for a couple of quarters in exchange for something. And generally the sponsors will very often provide equity, and that equity is used to pay down revolver, and the company kind of gets a new lease on life and gets to fight another day. Or the lender will offer to extend a maturity in exchange for either sponsors putting in equity, or maybe the sponsor getting more aggressive with looking for a sale of the company in an effort to pay down those loans. So we see this a lot. It's very collaborative, I would say. in contrast to the BSL market, where it can tend to be a bit more adversarial. So you can see that despite the PMR default rate being quite high, right, we're looking at, we ended the year at like 9.2%, and since then in February it only dipped to 9.1%. We have seen no software defaults in the portfolio for almost 2 years. I think the last software default we saw was July of 2024, and that actually, the recoveries on that default were quite high in the par or near par camp. So this is also despite software, as you would expect, being a pretty high percentage of the portfolio. So software is around 14% of the portfolio weighted by debt. And despite that, we really haven't seen a lot of defaults. Now, this year we've kind of we came into the year kind of forecasting that default rates would come down a bit, and that would be a function of really two things. One would be rates coming down, given what we said, the sensitivity of these lenders of these issuers to rates, and an increase in M&A. A loan that's paid down cannot default. So the expectation was M&A levels would increase. We really haven't seen either of those yet, so we'll see what happens. But going into this year, we were kind of expecting the overall default rate to come down. The software default rate has nowhere to go but up, right? You can't get lower than 0%. So there could be some upside. And when the portfolio in the private ratings portfolio, software is about 35 loans. So even a single default in that portfolio would take that default rate up into the low single digits.
Okay, thanks, Lyle. So what does this look like in terms of ratings in the sector?
Yeah, so in the PMR portfolio, again, it's a somewhat positive profile over the last couple of years, and you can see that from the chart. The percent of the portfolio that was CCC plus and below has declined over the last couple of years. You can see from 2023 to 2025, it's down from about 30% to 15%. And a lot of that has been absorbed by the higher rated tiers, right? You could see that it's not just B minus, it's in the B to B plus category has really captured a lot of that percent of the portfolio. Only a small portion of that action was due to rating actions. Like over the last 2 years, upgrades did exceed downgrades, but only by a very small number. But last year we did see 5 upgrades to just downgrades, to just 1 downgrade, sorry. So really the bulk of the improvement has been related to portfolio construction. Not, we're not managing a portfolio, but we are, it's a rated portfolio. So if I can call it that, we've just seen some lower rated names get paid off and higher quality new names, new issuers enter the rated portfolio. So if you turn to the next slide though, you can also see that the outlook distribution is pretty benign here. Most of the issuers in the portfolio do carry a stable outlook right now. And even the positives here outnumber the negatives.
That's, really interesting, good to know. And I'm wondering what we are anticipating in terms of refinancing risk, the maturity profiles of these loans.
Yeah, I'd say somewhat good news here as well. I think my biggest concern for this sector right now would be refinancing risk, just because valuations of software issuers have come down so much that I think it's going to be hard for sponsors that do face maturities or are looking to exit to get a bid that's acceptable to them, and that's going to be a problem for lenders who want to get out and for whom it's time to get out. But you can see in this chart that the maturity wall for the technology sector really doesn't kick in until 2031. If you look at 2026, there are no maturities in that portfolio. and only about 16% of the debt in the software portfolio matures through 2028. And that compares to around 45% of non-software debt that matures during the same period. So not a big risk on the horizon for this portfolio currently.
Okay, so this is a multi-year story, clearly. And before I turn to Chelsea to talk about BDCs, I just want to remind people that if you would like to access the slides, they are available on the resources box in the platform, but you may need to refresh your browser in order to see them. And I would also encourage people to submit questions to the Q&A. So Chelsea, let's get to you. I know that your team also, well, actually, the broader financial institutions team published a report very recently and talked about exposure to AI disruption across financial institutions. And one of the things that it discussed was that BDCs have the most exposure to industries at risk of AI disruption. So I'm wondering if you could talk to us a little bit more about BDCs and their exposure to software companies and what kind of risks you see there.
Sure. Yeah, so software is typically a top 3 industry exposure within many BDC portfolios. Based on public disclosures, we estimate that for the 33 BDCs that we rate publicly, software on average is around 20% of the portfolios at fair value. But this is likely understated for some BDCs because there are some that categorize software investments by end market. So it is a little tough from public filings to see total software exposure for some of those BDCs, but where there are disclosures available on that, we did include that in our metrics to get to that 20% average. In terms of credit performance, so far in the rising rate environment or higher rate environment, we've seen just very big dispersion in asset quality metrics across BDC portfolios in terms of differing levels of non-accruals, differing levels of realized losses. We attribute that to different underwriting standards across the space, differences in portfolio risk profiles and workout capabilities. And our view is that that same trend of differentiated performance is going to apply to the software portfolios as well. As Alan talked about earlier, it's not like all software companies are going to be impacted the same by AI. There are certain businesses that are more vulnerable, and some companies may adapt. And so our expectation is that, as Lyle mentioned in his kind of default rate where he said there's nowhere to go but up for software companies, we have seen very strong performance to date in software investments for BDCs. So our expectation is there will be some deterioration in the coming years within software investments, but we're not expecting really a meaningful change in 2026 because we do view it as more of a multi-year story given where the investment maturities are concentrated and given kind of some time for maybe some of these businesses to adapt to the AI environment. One thing that does kind of help us get comfortable with the larger exposure and the portfolio risk profiles is that BDCs, most of them are largely focused on first lien investments. So that's typically the majority of the investments in the BDC portfolios. The starting LTVs on these software investments were low at underwriting. That could, of course, tick up given what's going on with valuations. But generally, BDCs have cited, mid to high 30s starting LTVs on those portfolios. And we've also seen a meaningful decline in exposure to ARR loans in recent years. And so that the ARR loan exposure for the BDCs that we rate is pretty low and down meaningfully from where it was in 2021.
Okay, thanks for that. So obviously software exposure has lowered valuations and limited equity market access for BDCs. And how is this affecting the perpetually non-traded BDCs?
Yeah, so there's definitely been an impact across the sector for both the perpetually non-traded BDCs and the public BDCs from just more investor concern about AI disruption risks, since it is a large exposure for BDCs. That's driven wider bond spreads for BDC bonds, higher redemptions and slower inflows for the perpetually non-traded BDCs, and lower trading levels for the publicly listed BDCs. So most of the publicly listed BDCs that we rate today are trading below book, which affects their ability to issue equity for growth capital or to manage leverage. For the perpetually non-traded BDCs, we saw flows start to slow late last year in terms of both slower inflows as well as higher redemptions. So for the perpetually non-traded BDCs that we track, which includes more than just the 8 that we rate, there were 5 in that group that funded over the 5% max tender level in the fourth quarter of 2025. For most of those, it was just over 5%, with the one exception being Blue Owl Technology Income Corp, which funded over 15% redemption. And not surprisingly, that one was more impacted by concerns about software because it does have a technology and software focus. More recently, in the first quarter, for those that have reported so far, we've seen inflow slow further, and we've also seen redemptions increase further. So for the large platforms that have reported their first quarter tenders, they're kind of around, on a gross request basis, like 8 to 12%. Most of those are capping at the 5%. There were 2 exceptions that did fund around 7%, and both of those got some capital from their manager contributed as well. But generally, we've seen the perpetually non-traded BDCs start to cap at the 5%. In our view, that's prudent for leverage and liquidity management. That's our base case for the ratings for the perpetually non-traded BDCs that we do rate. And so our expectation is in the coming quarters, we'll continue to see slower flows, higher redemptions, but the impact on leverage and liquidity will be manageable because of that 5% cap. And so for the rated BDCs that we look at, they have typically several quarters of liquidity to handle max 5% quarterly redemptions. And then the other thing I just note is I mentioned earlier about the bond spreads. So we did see very strong debt issuance for the BDCs in 2025. That continued in the first 2 months of 2026, but has dropped off pretty meaningfully over the past month. But as a result of that strong issuance over the past year, we did see a reduction in refinancing risk for the rated BDCs. So our estimate is about over 60% of what was coming due this year was effectively pre-funded by issuances done last year and early this year. And in the interim, those BDCs used proceeds to pay down their credit facilities. So now they have capacity to draw on credit facilities and fund unsecured debt maturities if they need to. Most rated BDCs would still stay above our unsecured funding threshold for investment grade, which is at least 35% unsecured debt to total debt, even if they do refinance their 2026 maturities with secured borrowings. But there are a few that where the cushion is more limited on that metric. And so our expectation is in the near term, we will probably see slower issuance, particularly compared to last year, but there are probably some that'll look to continue to access the markets and may need to pay up a little bit to do so.
All right, thanks. Your team also ran a stress, and you were stressing software exposure in the BDC portfolios. I'm wondering if you could talk us through the results here on this slide.
Sure. Yeah, so as you can see from the green and yellow bars on this slide, which are the 25% haircut and 50% haircut to software investments, the vast majority of the rated BDCs would continue to meet asset coverage requirements, even under a stress of 50%. And that's assuming that they take no measures to offset that rising leverage as valuations are declining. So in reality, if that was happening, they would probably use some portfolio proceeds from repayments to pay down debt, but we're not giving any credit to that in this analysis. So this is just kind of a standstill haircut to the software portfolio. And we're certainly not expecting write-offs of this magnitude, just given portfolio diversity, limited near-term loan maturities, and the sponsor-backed nature of the investments, workout capabilities, et cetera. But this analysis does show that there is resilience even under a severe stress of 50%. In the 25% scenario, the asset coverage cushion would decline from the current level of around 24% at year-end to around 20%. And then under the 50% scenario, the average asset coverage cushion would fall a bit further to around 15.6%, but that's still within our investment grade benchmark. There are two BDCs, which are Blue Owl Technology Finance Corp and BlackRock TCP Capital Corp, that under our 50% scenario would breach the asset coverage requirement. But again, we're not expecting write-offs of that level. And also, as I mentioned earlier, that kind of assumes that they're not taking any measures to bring leverage back down. So overall, we feel good about the portfolios, the starting asset coverage cushions, and the stress that the BDCs would be able to withstand from a valuation perspective should those investments get marked down or there be some more realized losses in those books.
Thanks for that. And I would also say that this was published recently, and that published stress scenario is on, I believe, in the resources. So people can access the details there as well. All right, thanks, Chelsea. Defina, let me turn to you. Alternative investment managers generally have lower software exposure than BDCs, but what have you observed, and who has the largest exposure in the sector you cover?
Sure. Thanks, Sarah. Yes, that's true. So the alternative investment managers tend to be more diversified, managing private equity, private credit, real estate, infrastructure. So the software exposure is more modest at the manager level relative to BDCs. And so the range you can see on the slide here is from 2% of AUM to 11% of AUM for the rated peers that we cover. And you can see that TPG is at the high end, Apollo is at the low end. The software exposure for alternative investment managers tends to be more in the credit portfolio. In some of the BDCs, Chelsea talked about the BDCs a bit earlier, the asset managers that have affiliated BDCs, contribute a significant portion to the overall exposure at the manager level. So she talked about some of the protections there with the low loan to value, so significant equity cushions, significant cash yields still being generated on those portfolios. Lyle talked a bit about kind of the revenue growth declining, but still quite significant in the double digits, still continuing to generate earnings. So there are some protections for the credit portfolio. I'd say that TPG is an exception in that most of their exposure is in private equity. So, obviously the private equity portfolio would tend to have less protection, be more susceptible to impairment as the first loss position. But during our conversations with the management teams, TPG has been a net seller of private equity in general, kind of post-COVID when valuations were elevated. So 2021, 2022. And, while we don't have, significantly granular details around kind of what was being sold, they do highlight that a significant portion of, or a good portion of the software book, they were net sellers of those assets during that period. And so the vintage of their current exposure is post kind of the advent of AI. And so they're able to sort of underwrite the dynamics and the risks and the rollout of AI and any disruption risk into the deals that they were underwriting. So, so the vintage exposure, I think, is important here. And I will say that the asset manager risk is different from the BDCs in that this is not direct balance sheet risk. These investments are held through investment funds where the investors hold the risk. So the risk to the asset manager is more around management fees. And so, again, this represents 2 to 11% of AUM. The vast majority of the AUM is outside of software. And these asset managers continue to be strong gatherers of inflows. So, while fundraising is not as robust as we had seen in years past, it still remains quite significant. So, to the extent that there is disruption within this portion of the book, they continue to generate inflows. So we don't expect a significant impact on overall management fees for the asset managers.
All right. Thanks for that. So other than disruptions, I know you've talked about in pieces that you've also published about how alternative investment managers are positioned to benefit from market disruption and AI-related investments. So I'm wondering if you could talk a little bit more about that.
Yeah, and I think that's an important point. So there was a lot of, Alan talked earlier about kind of the companies that are positioned to be most disrupted by AI. And again, during our roadshows, a lot of the managers are talking about the types of investments that they have. And less of that exposure is in those areas that are more like digital content creation, areas that are most likely to be disrupted, and more in kind of the vertical software platforms that could potentially benefit from AI. Obviously, I'm not an expert in AI, and I think we're all kind of learning along the way. So I think it'll take time to see the winners and laggards sort of emerge over the coming years. But what I do think does allow for asset managers to sort of benefit or at least hedge their current positions is the significant amount of dry powder that they have. So they have a lot of capital to be able to put to work, to the extent that the market disruption creates valuations that then become attractive entry points for new investment capital. So there's the ability to sort of hedge existing positions and get in at lower valuation levels. And then outside of just kind of the software disruption aspect of AI, there's also the digital build out for the rollout of AI. So a lot of the capital that is needed for the Amazons of the world, the Metas of the world, and all of the hyperscalers to build these data centers and the digital infrastructure is being financed in the private markets. So a lot of the rated peers that we rate are providing capital, both equity and debt, to finance the build out of those with significant capital, especially on the debt side, significant capital beneath them through the equity providers and even through the hyperscalers themselves. So we do think there are some tailwinds that this sector could benefit from with the continued rollout.
All right, good to know. Thanks. So I think what we can do now is move to Q&A, and I would encourage anyone who has a question to please enter that into the Q&A box. We did have a question about if we can discuss more the winners and losers, and I'll just say off the bat that there's been a number of reports that we published, short commentaries as well as longer format reports that do go into those entities in different sectors where we think that there's greater vulnerability. One which I mentioned, I don't know if it's in the resource page, but it was exposure in the FI sector. And Alan, I'm wondering if you could tell us the names of the two reports that you worked on recently that also go into more detail about the AI ecosystem and where you see vulnerabilities there, and winners and losers.
Sure. Yeah. So I think Delphina kind of touched on some of these data center build-outs. We did publish a report just last week that basically talks through the entire AI ecosystem through the lens of value chain analysis, right? So we look at everything from data centers to IT equipment providers, through the guys who are actually building the data centers, and then further downstream, right, to the service providers and to who the end users are. And then, to flip that around, right, we also look at, just kind of looking at the macro level, right, how much AI service revenue can be generated realistically in the next 4 to 5 years, and whether that lines up with the level of CapEx that's going into the ecosystem currently. So I encourage you to have a look at that report, and the conclusion of that report was that it does appear that there's sufficient revenue opportunities in AI services to justify the level of CapEx. Currently, if you kind of back out the non-AI CapEx, right, the real AI CapEx probably around 450 to 500 billion annually. So we do arrive at the conclusion that the investments and the opportunities they do seem to line up.
Thanks. And we mentioned the Beyond the Hyperscalers report earlier, which does break down for 14 different corporate sectors, those most vulnerable to AI disruption risk and overinvestment risk. So that's another good report to reference. And then Ellen, there's a specific question about the criteria that we might employ to break software into buckets, about those most at risk versus those less at risk. I don't know if you could talk about that.
Yeah, so it's more of a qualitative exercise where we went through every single name within our portfolio coverage, but some of the key attributes that we look for, right? It kind of gets a bit technical into the software stack, but I think really they're kind of boils down to like 6 different attributes, right? One is determining whether the specific product. The function can be replaced by AI, right? That's kind of the first question we ask, and then other questions that are also being considered. What is the complexity of integration, right? Even if the function can be replaced by AI, but if it's so deeply integrated within the workflow, the switching cost is still extremely high. And then and you kind of look at software covers a wide range of product and the different layers of the software stack, right? The products that are considered system data infrastructure, they're so low in the software stack. Even for AI to work, right, those systems have to remain intact and accurate, right? So we view those products to be very protected. And then some of these software products we see them as software, right? But really their value, their moat is actually from network effect, right? So we do consider those network effects to be extremely powerful as well. And proprietary data, right? I think some of these products they're not just providing some output, right? They actually have proprietary data that they run on top of, right? That's also protected. And then we talk about kind of regulatory type of industries, regulated industries, right? That's where I think the precision, the accuracy of the output is crucial, right? So we do view that attribute also to be quite protected. So generally, right, yeah, it's these 6 attributes that we think about to assess whether a particular product and a software company is in high risk or low risk or medium risk category.
All right, that's very helpful. Thank you. We had a question on BDCs and how their valuations are affected. Chelsea, I believe you touched on this in your portion of the presentation, but maybe you could provide a little more detail.
Sure. Yeah, so in terms of the impact on the valuations within the BDC portfolios, we haven't yet seen that play out because these are typically reported on a quarterly basis. So the last financials that we have for the BDCs are with the valuations done as of December 31st of last year. So that was before recent dynamics, and our expectation is that in the first quarter, once results are reported with March 31st valuations, we will see an impact of the recent trends in the software space. So typically, wider spreads on certain sectors will result in a higher discount rate, which will bring valuations down. So that's our expectation, is certainly that there will be a level of valuation decline from just the market impact during the first quarter. And then the other element that is key in valuations of the investments is the individual company dynamics and their performance. That part will probably take some more time to play out, as I talked about earlier. So not expecting a significant deterioration in marks from just a credit performance standpoint in the first quarter, but there definitely will be some market impact.
Thanks for that. We also had a question on recovery values for our privately managed portfolio, private credit. Lyle, is it something you could maybe spend a minute or two talking about?
Yeah, sure. I can try. So
okay.
For those of you familiar with our methodology, to get to an instrument rating for a particular debt instrument, we assign an IDR, which is our issuer default rating, which reflects our estimate of a likelihood of an issuer defaulting. And then we notch from that IDR based on our expectations for how an instrument might recover during a hypothetical bankruptcy. And it is admittedly a tough thing to do sometimes for software companies where revenue or EBITDA might be quite low in the early stages. In some cases, it's negative, particularly in the case of ARR loans. So it's a bit of more of an art than a science, trying to figure out, trying to determine what a recovery might be on an instrument like that. So, and Alan, feel free to hop in and correct me or make some points of your own. But I think what we do is tend to look at it. If this company were to maybe get bought by another company, kind of take out some of those software acquisition costs, what would kind of a going concern EBITDA level look like, right? Taking out some of those costs and estimate a recovery based on that. And I think when it comes to the software portfolio, and again, Alan, feel free to jump in, I think you're probably looking at recoveries along the lines of kind of average recoveries, probably, we call it RR4, which is like 30 to 50%, which, in the context of a first lien loan is probably a bit light. You might expect a first lien loan to recover in the 60 to 70% area. So I'll pause there. Alan, I don't know if there's anything you wanted to add.
Yeah. Thanks. Yeah, I think Lyle, you're exactly right. I think for a lot of these software companies in the private portfolio, they tend to be smaller, early stage type of software companies that could be growing very rapidly. And if you look at the operating expense, the cost structure, they generally spend quite a bit of OpEx on sales and marketing to drive their revenue growth. In a scenario where they need to cut costs significantly, through an acquisition by either by a competitor or by a larger company, they can substantially reduce their operating expenses, either by just simply through operating leverage or simply leverage the acquirer's infrastructure to actually perform some of these operating functions. So that's kind of how we generally look at these the recovery. It's that there's the potential for that OpEx to actually be reduced quite substantially.
Thanks, Alan. Thanks, Lyle. One question, I'm going to switch to the default side because, Deb, I'm just wondering, we had somebody ask about defaults, and I think you had discussed this a little bit, how we expect some rising software defaults or have seen some rising software defaults. Could you address what you were talking about here?
Sure. Yeah, sure. Yeah. I think the question was about, are there any themes in those defaults that we've seen? And a lot of them were niche software companies that just couldn't be competitive against the incumbents. And also the trend was for them to go back to lenders and negotiate. So these were also primarily DDEs. And so a lot of these companies are actually still operating. So it's not that they've disappeared, it's just they restructured, defaulted at the time, and are still operating, but they're mostly niche software companies.
One thing I thought we would see post-COVID was, and we saw one default in our portfolio related to that. That was the one software default in 2024 was just related to online learning, online education. And post-COVID, everybody thought everything was moving online, and these companies ramped up, took on a lot of debt, and then people started going back to offices. I thought we'd see more of a trend along those lines. It's not an AI trend necessarily, but we did see literally a handful in 2024, Pluralsight being one of them. But that trend really didn't materialize to any great degree.
Okay. Thank you both. So, Defina and Chelsea, this is a question for both of you in the sectors that you're covering. I'm wondering what you're expecting to see, not just in 2026, but can you give us a view maybe further out? Do we, I know that Chelsea, you had mentioned, so this is a multi-year story, as Lyle had discussed as well. So,
yeah, I can start, and I think that's exactly right. Like, I don't think that our expectation is that you'll start to see kind of the issues play out in the near term. Certainly, I think there'll continue to be some valuation volatility, but certainly the majority of the maturities are beyond 2027, 2028 into the kind of 2020, 30. So I think and managers will try to get ahead of these upcoming maturities. So I think we'll, over the next few years, start, begin to assess, what early actions they can take to get ahead of some of these maturities. But by and large, I would expect that, the challenges will be more prolonged beyond kind of the next 3 to 4 years.
Okay. Thanks. Chelsea, anything to add to that?
No, I think Dafina covered it well. Similar view.
Okay, great. Fantastic. All right, thank you. All right, I think we are running out of time, so I will wrap it up. But I will say that if you had questions that were not answered, we will present our contact details at the end, and you can reach out to us. And the questions in the chat, we can certainly try and answer via email. If you needed to try and access the slides, please try and refresh your browser. You should be able to see the slides for this event there. But again, you can reach out if you're not able to see them. So with that, I will just say thank you very much to all the panelists and analysts for their time and for their insights today. I also want to thank the audience for joining us, and we very much value your feedback. So if you could take a minute or two to complete the survey that's in the survey box, we would appreciate it. And if you, some people have asked this, so I'm pleased to let you know that there will be a webinar replay that will be sent out, and it will be available, I believe, one day within 24 hours of this live webinar, and you can access it using the same link that you used to log in today. So with that, we will wrap up, and thank you all and have a good day.